Why do most people lose money in crypto? Even when they pick the right coins, even when the market goes up, even when they think they're doing everything right. What if I told you it's not the market? It's not Bitcoin, it's not altcoins, it's not even bad luck. It's something much closer to home. And once you see it, you can't unsee it. Let's talk. Because this one reason is silently draining more portfolios than any crash, any bear market, any scam, any rug pull in history. And almost nobody talks about it honestly. Here's the uncomfortable truth. Most people don't lose money in crypto because they chose the wrong coin. They lose money because they chose the right coin at the wrong time with the wrong mindset and the wrong behavior. And behavior beats knowledge every single time. You can understand blockchain, you can understand tokenomics, you can understand market cycles, and still lose money. Because the market doesn't reward intelligence, it rewards emotional discipline. And that's where most people collapse. So today, I want to break this down into 5 simple truths. 5 reasons that explain almost every blown account, every missed opportunity, every emotional trade, and every painful bag. And by the end of this video, you'll either see yourself in it, or you'll realize why you've been outperforming most people without even knowing it. Let's start with the real reason. 1. People don't manage their emotions, they let the market manage them. This is the core problem. Not charts, not news, not fundamentals, emotions. And crypto is an emotional machine. Think about it. Crypto doesn't just move, it explodes, it collapses, it goes up 40% in a week, then drops 60% in 3 days. That kind of volatility doesn't just move price, it moves your nervous system. It hits your dopamine, your fear, your greed, your ego. And if you don't control those, they control you. Here's what that looks like in real life. Price pumps. You feel smart, you feel validated, you feel like you finally get it. So you buy more. Not because it makes sense, not because the setup improved, not because the risk-reward got better. You buy because you feel safe. And that's when you're actually at the highest risk. Then price drops. Suddenly, the same coin you loved now feels dangerous. You feel stupid, you feel embarrassed, you feel anxious. And instead of following a plan, you react. You sell. Not because the fundamentals changed, not because your thesis broke, not because the trend actually reversed. You sell because the pain got too loud. So what happens? You buy high, you sell low, and you repeat. And you slowly convince yourself that crypto is a scam. But the market didn't scam you. Your emotions did. Let me make this painfully clear. The market doesn't care about your entry. It doesn't care about your losses. It doesn't care about your feelings. It only responds to liquidity, psychology, and time. And if you don't train your psychology, you become liquidity. That's the brutal truth. Most people think they're trading the market. They're actually trading their emotions. And the market is better at that game than you will ever be. 2. People chase outcomes instead of building systems. This one is subtle and it's deadly. Most people don't approach crypto as a system. They approach it as a lottery ticket. They don't say, I want to build a repeatable process that compounds over time. They say, I want to make money fast. And that difference changes everything. When you chase outcomes, you chase pumps. You chase narratives, you chase influencers, you chase screenshots, you chase green candles. You jump from coin to coin, from strategy to strategy, from thesis to thesis. Not because anything changed, but because your emotions did. And what happens? You never let anything play out. You exit too early, you enter too late, you abandon good positions for bad ones. You turn long-term ideas into short-term mistakes. Let me give you a simple example. Imagine someone buys Bitcoin at $20,000. It goes to $30,000. They feel smart. Then it pulls back to $25,000. They panic. They sell. Then it goes to $60,000. They feel like an idiot, so they buy back in at $58,000. Then it drops to $45,000. They panic again. They sell again. This person didn't lose money because Bitcoin failed. They lost money because they had no system, no rules, no structure, no patience, just emotion-driven decisions. Here's the difference between winners and losers in crypto. Winners don't rely on feeling, they rely on frameworks. They don't ask, is this exciting? They ask, does this fit my strategy? They don't ask, is this going up right now? They ask, is this undervalued relative to its long-term adoption? They don't ask, what is everyone buying? They ask, what is everyone ignoring? Most people want results. Very few people want process, but only process produces consistent results. You don't get rich in crypto by guessing right once. You get rich by doing the same boring, disciplined, emotionally uncomfortable things over and over again. Buying when it feels wrong, holding when it feels scary, taking profits when it feels euphoric. That's not exciting. That's effective. 3. People don't understand time, and time is the real edge. This one is huge. Most people don't lose money because they were wrong. They lose money because they were early, or late, or impatient. Crypto is not a get-rich-quick market. It's a get-rich-slowly, then suddenly market. And most people can't handle the slowly part. Think about every major crypto success story. Bitcoin, Ethereum, Solana, Chainlink, even meme coins. None of them went straight up. They chopped, they bled, they went sideways, they bored people to death, and then they exploded. But almost nobody is still holding when that happens, because most people quit right before the payoff. Here's what usually happens. You buy a coin, you're excited, you believe in it. Nothing happens. Weeks go by, months go by, it feels dead. Meanwhile, other coins are pumping. You start to feel stupid, you start to feel embarrassed, you start to feel anxious. And instead of following a plan, you react. You sell, not because the fundamentals changed, not because your thesis broke, not because the trend actually reversed. You sell because the pain got too loud. So what happens? You buy high, you sell low, and you repeat. And you slowly convince yourself that crypto is a scam. But the market didn't scam you. Your emotions did. Let me make this painfully clear. The market doesn't care about your entry. It doesn't care about your losses. It doesn't care about your feelings. It only responds to liquidity, psychology, and time. And if you don't train your psychology, you become liquidity. That's the brutal truth. Most people think they're trading the market. They're actually trading their emotions. And the market is better at that game than you will ever be. 3. People don't understand time, and time is the real edge. This one is huge. Most people don't lose money because they were wrong. They lose money because they were early, or late, or impatient. Crypto is not a get-rich-quick market. It's a get-rich-slowly, then suddenly market. And most people can't handle the slowly part. Think about every major crypto success story. Bitcoin, Ethereum, Solana, Chainlink, even meme coins. None of them went straight up. They chopped, they bled, they went sideways, they bored people to death. And then they exploded. But almost nobody is still holding when that happens, because most people quit right before the payoff. Here's what usually happens. You buy a coin, you're excited, you believe in it. Nothing happens. Weeks go by, months go by, it feels dead. Meanwhile, other coins are pumping. You start to feel stupid, you start to feel embarrassed, you start to feel anxious. And instead of following a plan, you react. You sell. Not because the fundamentals changed, not because your thesis broke, not because the trend actually reversed. You sell because the pain got too loud. So what happens? You buy high, you sell low, and you repeat. And you slowly convince yourself that crypto is a scam. But the market didn't scam you. Your emotions did. Let me make this painfully clear. The market doesn't care about your entry. It doesn't care about your losses. It doesn't care about your feelings. It only responds to liquidity, psychology, and time. And if you don't train your psychology, you become liquidity. That's the brutal truth. Most people think they're trading the market. They're actually trading their emotions. and the market is better at that game than you will ever be. 3. People don't understand time, and time is the real edge. This one is huge. Most people don't lose money because they were wrong. They lose money because they were early, or late, or impatient. Crypto is not a get-rich-quick market. It's a get-rich-slowly, then suddenly market. And most people can't handle the slowly part. Think about every major crypto success story. Bitcoin, Ethereum, Solana, Chainlink, even meme coins. None of them went straight up. They chopped, they bled, they went sideways, they bored people to death. And then they exploded. But almost nobody is still holding when that happens, because most people quit right before the payoff. Here's what usually happens. You buy a coin, you're excited, you believe in it. Nothing happens. Weeks go by, months go by, it feels dead. Meanwhile, other coins are pumping. You start to feel stupid. You start to feel left out. You start to feel like you chose wrong, so you sell. Not because your thesis broke, not because the project failed, not because the fundamentals changed. You sell because nothing happened fast enough. Then months later, that same coin does a 5x, and you're not in it. That's not bad luck. That's bad time management. Crypto rewards patience more than intelligence. Let me say that again. Crypto rewards patience more than intelligence. You can be average intellectually and still outperform if you can just wait. But most people can't. They need constant feedback. They need constant stimulation. They need constant movement. And crypto doesn't work like that. The biggest gains come from long periods of boredom, followed by short periods of insanity. Most people only show up for the insanity and miss the boredom that created it. If you want to win in crypto, you have to fall in love with the boring part, the accumulation, the research, the waiting, the doubt, because that's where the real money is made. 4. People confuse information with conviction. This one is sneaky, and it destroys portfolios quietly. Most people think they have conviction, but what they actually have is information. They've watched videos, they've read threads, they've seen charts, they've heard narratives, but that's not conviction. Conviction is what holds you when price moves against you. Conviction is what keeps you calm when everyone else is panicking. Conviction is what allows you to buy when sentiment is dead and sell when sentiment is euphoric. Most people don't have conviction. They have borrowed confidence. They feel confident when the influencer is bullish. They feel confident when the chart is green. They feel confident when Twitter is loud. And they feel terrified when all of that disappears. That's not conviction. That's dependency. And dependency makes you weak in volatile markets. Let me explain this clearly. If your confidence comes from external validation, you will always exit at the worst possible time, because the moment price drops, your validation disappears, your confidence collapses, your fear spikes, your logic shuts down, and you make emotional decisions. Real conviction comes from internal understanding, from knowing why this project exists, what problem it solves, who uses it, why it matters, what could kill it, what could grow it. When you understand that deeply, price becomes noise, volatility becomes opportunity, red candles become discounts, not disasters. But when you don't, every dip feels like a threat, every pullback feels like the end, and every pump feels like proof you're right, even when you're not. Most people lose money not because they lacked information, they lose money because they lacked conviction, and conviction only comes from doing the work. Not scrolling, not watching, not copying, thinking, studying, understanding, and then acting consistently with that understanding. 5. People don't have a plan, they have hope. This might be the most dangerous one, because hope feels positive, it feels optimistic, it feels motivating, but in trading and investing, hope is a liability. Here's how most people operate. They buy a coin, then they hope it goes up. That's the entire plan. No entry logic, no exit strategy, no risk management, no position sizing. Just hope. Hope it pumps, hope it moons, hope it saves their portfolio, hope it changes their life. And hope is not a strategy. Hope is what you have when you don't have a plan. Let me give you a simple truth. If you don't know when you'll buy, how much you'll buy, when you'll take profits, when you'll cut losses, what invalidates your thesis, then you're not investing, you're gambling. And the market always wins against gamblers. Always. Not because it's evil, but because it's structured around probability, not emotion. Professional traders lose often, but they win more than they lose. And when they lose small. Most retail investors win sometimes, but when they lose big. Why? Because they don't have rules. They don't define risk. They don't define exits. They don't define failure. So they hold losers too long and sell winners too early. They hope losers recover and fear winners will reverse. That's the exact opposite of what works. Let me make this simple. You don't need to predict the market. You need to prepare for it. Preparation beats prediction every time, because the market will always do something unexpected. And if your strategy only works when you're right, you'll lose. A good strategy works even when you're wrong. That's the difference. Now, let's connect all of this into one single reason. Here it is. Most people lose money in crypto because they don't have emotional mastery. That's it. Not the market, not Bitcoin, not altcoins, not volatility, their own behavior. They let fear dictate their exits. They let greed dictate their entries. They let boredom dictate their patience. They let hope replace planning. And over time, that behavior compounds in the wrong direction. Not 10%, not 20%, but 90%. That's why most people leave crypto worse off than they entered. Not because crypto failed, because they failed to evolve. Now, here's the part nobody wants to hear. You don't fix this by finding better coins. You fix this by becoming a better investor. And that starts internally, not externally. So let's talk about actually fixing this. Not theory, not motivational quotes, actual practical changes. First, you need to define your identity. This is deeper than it sounds. Most people don't know who they are in the market. Are you a trader, an investor, a long-term holder, a cycle investor, a momentum trader, a value accumulator? Most people say all of the above. That's the problem, because each of those requires a completely different mindset. A trader needs speed, an investor needs patience, a long-term holder needs conviction, a momentum trader needs discipline, a value accumulator needs emotional control. You can't be all of them at once, at least not with the same capital. You need to choose. Who are you in this market? Once you define that, your decisions become easier because you're no longer reacting. You're acting according to identity. I don't trade this way. I don't exit this early. I don't chase pumps. I don't sell during fear. That kind of clarity changes everything. Second, you need rules, not opinions, not vibes, not feelings, rules. Rules for entry, rules for exit, rules for position size, rules for risk, rules for profit taking. And you need to follow them, especially when it feels wrong, because the moments that feel wrong are usually the moments that matter most. Let me give you a simple example. Rule: never allocate more than 5% of your portfolio to a single altcoin. Why? Because even if it goes to zero, you survive. But if you don't have that rule, you'll eventually go all in on something. And eventually, that something will fail. Not because you're stupid, because failure is part of the game. Rules protect you from your worst impulses, and the market is designed to trigger those impulses. So if you don't have rules, you are exposed. Third, you need to separate your ego from your portfolio. This is hard because money is emotional. Money feels like identity, like intelligence, like worth. When you lose money, it feels like you lost something about yourself. And when you make money, it feels like you gained something about yourself. That's dangerous because it turns investing into a psychological battleground. You start needing to be right. You start defending your positions emotionally. You start ignoring evidence that contradicts your thesis. You start doubling down to prove yourself. And that's how accounts die. You need to learn how to be wrong without being emotional. To say, I was wrong, I'll adjust, I'll move on. No drama, no shame, no attachment. Because the market doesn't reward loyalty to ideas. It rewards loyalty to reality. And reality changes fast. 5. You need to stop consuming content emotionally. This one is subtle but powerful. Most people consume content to feel something, to feel excited, to feel confident, to feel validated, to feel hopeful. They're not consuming content to think better. They're consuming content to feel better. And that creates a feedback loop. You only watch bullish videos when you're bullish. You only watch bearish videos when you're scared. You reinforce your current emotional state. That makes you more reactive, more extreme, more unstable. Instead, you need to consume content strategically, to challenge your views, to test your assumptions, to strengthen your conviction, not to hype yourself up, not to calm yourself down, but to sharpen your thinking. That's a completely different relationship with information. Fifth, you need to zoom out. Most people are emotionally trapped in the 5-minute chart, in the hourly chart, in the daily candle, and that's where most of the emotional damage happens. But when you zoom out, everything changes. A 30% dip on the 5-minute chart feels catastrophic. On the weekly chart, it's noise. A sideways market for 6 months feels like death. On the 4-year cycle, it's accumulation. A crash feels like the end. On the adoption curve, it's normal. Perspective is emotional armor, and most people don't wear it. They live in the micro. They panic in the short term. They ignore the long term, and the market punishes that behavior relentlessly. Now, let me tell you something most people never realize. You don't need to be early. You need to be patient. You don't need to find the next Bitcoin. You need to avoid being shaken out of the good ones. You don't need perfect timing. You need consistent behavior. The difference between someone who loses money in crypto and someone who builds wealth in crypto is not intelligence. It's emotional discipline over time. That's it. That's the whole game. Not predictions, not charts, not news. Behavior. Now, let's talk about what winning actually looks like. Not in theory, in reality. Winning in crypto looks boring most of the time. It looks like holding when nothing is happening. It looks like buying when sentiment is dead. It looks like ignoring noise. It looks like waiting months or years. It looks like taking profits when everyone is euphoric and it feels wrong. It looks like sitting out when everyone else is gambling. It looks like missing pumps and being okay with it. It looks like doing nothing and trusting your system. That's not sexy. That's not viral. That doesn't get clicks. But that's how wealth is built. Not through excitement, through consistency. Let me ask you something. How many times have you bought something because it was pumping, sold something because it was dumping, changed your strategy because of one bad trade, abandoned a position because you got bored, ignored your plan because you felt confident, entered without an exit, held a loser hoping it would recover, sold a winner too early because you were scared? If you've done any of those, and most people have, you're not bad at crypto. You're human. But the market doesn't reward human instinct. It rewards trained behavior, and that's the shift you need to make. From reacting to responding, from guessing to executing, from hoping to planning, from emotional to intentional. Now, let's bring this full circle. The reason most people lose money in crypto is not the market. It's not Bitcoin. It's not volatility. It's not manipulation. It's not whales. It's not institutions. It's not regulation. It's not news. It's not bad projects. It's not scams. It's not timing. It's not luck. It's their own behavior under uncertainty. That's the real enemy. And once you see that, everything changes, because now the problem is solvable. You can't control the market, but you can control yourself. You can't predict price, but you can prepare for it. You can't avoid volatility, but you can stop letting it control you. You can't eliminate risk, but you can manage it. And when you do that, crypto stops being a casino and starts becoming a tool for wealth, a tool for sovereignty, a tool for long-term freedom. Not through gambling, through discipline. So here's your real takeaway. If you want to stop losing money in crypto, stop trying to beat the market and start mastering yourself. Build a system, define your rules, clarify your identity, detach your ego, zoom out, control your emotions, trust your process. Do that consistently, and the market will eventually reward you. Not immediately, not dramatically, but inevitably, because markets reward behavior over time, and if your behavior is solid, your results will follow. Now, if this video made you reflect even a little, if you saw yourself in any of this, if you realized that your biggest enemy in crypto might not be the market, but your own reactions, then you're already ahead of most people, because awareness is the first edge, and the second edge is execution. So here's what I want you to do. Not tomorrow, not next week, now. Go define your strategy. Write down who you are in the market, how you enter, how you exit, how much you risk, what invalidates your thesis. Make it real, because until it's written, it's not a strategy, it's a feeling, and feelings don't survive volatility. If this helped you think differently about crypto, if this saved you even one emotional trade, if this made you pause before chasing the next pump, then subscribe. Not for hype, not for predictions, but for clarity. Because in a market full of noise, clarity is alpha. And if you want to build real wealth in crypto, not just stories, this is where it starts, with you.